Ahead as one big catalyst may be getting ready to mobilize, which is retail. I thought retail investors already were mobilized. Fundstrat's head of research, Tom Lee, is here. He's a CNBC contributor. It's great to have you here, Tom. What do you see going on here?
Well, I think that investors got very cautious into the buildup of the war, and they were getting cautious because many stocks held by retail were getting hit. You know, the software stocks, and as that fell, we know there were record inflows into software. And of course, the Mag 7 had been falling. So I think investors viewed the war and the start of the war as a time to take risk off the table, which was very different than what we saw a year ago when investors were buying into the tariff lows. And now I think that the downside tail risks have been removed for the war. Hedge funds have been early and they've been adding risk, and that we can confirm that from talking to our clients. And I think now it's retail investors that are now beginning to take money off the sidelines and buy stocks.
Maybe this is a psychological or a political question. I'm just curious if you have any insight as to why they would react differently to the Iran war versus not just tariffs, but anything else politically that's happened. I mean, buy the dips has become a well-known catchphrase. So it's surprising that they were, you think, kind of going the other way this time.
It is surprising. I was quite surprised because I would have assumed if someone asked me in 2026, a war is going to start, what will retail do? I would assume that they'd buy the dip. But in our surveys with our clients, we found that many maybe had policy puzzlement. You know, they didn't really know how big this war could become. You know, their biggest fear was gasoline spiking and we could get a recession or a depression, and a lot of economists warned of that. So I think it was difficult for investors to say, we can trust what the administration's doing, because there were too many people warning about the tail risks of that.
Is it possible they're right? You know, I was in a store earlier today and the radio was on. I haven't heard the radio in a long time. And the DJ it was some kind of pop or kind of broad station. And he was saying, you know, another check on gasoline prices, and boy, aren't they high? And I thought, wow, that's the first time I've heard gasoline prices talked about in a non-business news context in a while. Is it possible that actually there is going to be a bigger impact here and the retail investors actually know that, and maybe the pros are missing it?
I mean, anything's definitely possible. One thing that we were at Fundstrat were emphasizing is that inflation adjusted, even gasoline prices here aren't nearly the burden they were 5 years ago, 10 years ago, even at the '08 peak. And the war is stimulating the economy, and we can see that in the earnings estimates, in the ISM, and even the jobs report. So I think the state of the consumer is one thing versus maybe how they might hear in a radio commercial or the surveys, but I do think the consumer is in better shape. So I think the retail investor will end up chasing this stock rally.
And you think as they do, that will power it higher?
Yes, but for the right fundamental reasons, because earnings estimates are higher. The U.S.'s relative position has really been strengthened by what's been exposed by supply chains through this war. And I think as the world investor looks for growth and they worry about growth in general, they're going to buy the U.S. stock market, which is a growth index.
We're going to talk in just a moment about international and whether, you know, you should, not that you have to choose, you can do both, but if you had to pick U.S. versus international, is it U.S.?
I'd still be overweighting U.S. because I think if you think about where innovation comes from, whether it's in tech, healthcare, or financial services or fintech, that's really U.S. companies. And I think there was an argument the U.S. PE should derate, but the war has exposed that the U.S. multiple should be going up.
Really? So that could be accounting. We could get both earnings and multiple expansion this year?
Yes, I think once we're through, this is still going to be a very tricky year because we have a new Fed chair coming in. The market's going to test that Fed chair. But once we get through that subsequent turbulence, we are probably entering, an 18 to 24-month period that might be one of the best we've ever seen in our life.
We'll see. As we just said, living through history. Steve said we're always living through history. Maybe we'll get a chance for the new best period of our investing lives. Tom, thanks. Appreciate it. Tom Lee of Fundstrat. Coming up,
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Hi there, this is Tom Lee. I'm the Chief Investment Officer of Fundstrat Capital and the lead portfolio manager for Fundstrat's family of ETFs, Granny Shots. This is our update for the week of April 20th. First, let me start with some particulars. As of April 17th, Granny, the large cap ETF Granny, had a price of $26.24, net asset value of $26.24, and total assets of $4.3 billion. Granny J, which is the small and mid-cap Granny ETF, had a price of $28.74, NAV of $28.71, and total assets of $434 million. And Granny I, which is the income-oriented Granny, had a price of $20.63, NAV of $20.66, and total assets of $49 million. Over the past week, large cap Granny gained 5% versus a 4.5% gain for the S&P 500, or 52 basis points of relative outperformance. Granny J gained 6.69% compared to a 4.9% gain for the Russell 2500, or 175 basis points of outperformance. And Granny Income gained 4.58% compared to a 4.55% gain for the S&P, or roughly 4 basis points. Now, if we look at the year-to-date performance, Granny is up 6% for the year compared to 4.5% for the S&P 500, or 150 basis points of relative outperformance. Granny J is up 12.5% for the year compared to 12.89% for the Russell 2500, underperforming by 46 basis points. And Granny Income is up 4.9% compared to 4.47%, or 47 basis points of relative outperformance. So let's direct our attention to macro, and there's a couple things I want to highlight this week. The first is that we're in the midst of first quarter earnings season, and 93 companies are going to report this week in the S&P 500. So it's a pretty heavy week, and it's going to include both Granny shots, which are marked here in red, and junior Grannies, which are marked here in blue. And notably, companies like Tesla report this week. Now, overall, it's been a good earnings season. We're only 10% into earnings season, but companies are beating by 92%. I mean, that's a big number. 92% are beating, and an 11% overall surprise. Now, earnings season really heats up over this week and the next 2 weeks. And if you want to know where performance is coming from in terms of earnings growth, 3 sectors are driving earnings growth: financials, materials, and technology, while energy, healthcare, and comm services are actually negative year over year. The other thing I want to talk about is the new Fed. The confirmation process is starting this week for Kevin Warsh. And let's get a timeline for what it looked like in the past from that point on to when he'll actually be confirmed. Well, typically, it's 7 days later when the committee will hold its vote. Okay, so that's 7 days from now or next week sometime. And then, as you can see, the Senate will have a floor confirmation vote. And in Greenspan's case, that came only 6 days later. But for the Bernanke, Yellen, and Powell, that was more like 50 to 70 days. So I think that's the timeline to think about, which means we could have a new Fed chair in place sometime between June and July 2026. Now, recall what I've pointed out in the past. The market always tests a new Fed. This is a table from Barclays and what happened in the first year of a new Fed chair. But let's mark periods of 10% or worse declines. 10 of 13 Fed chairs had a drawdown of more than 10% in the first year. So I think it's more the rule than the exception that we'll get a big drawdown. Now, what does it mean for markets? Well, we've had a V-shaped recovery from the war lows, but that's more or less the rule, not the exception, because 9 of 13 bottoms have been V-shaped. So that takes us to our roadmap for the year. We originally said that the market could get towards 7,300, and it looks like we're on a path towards that. We're well over 7,000. And then we'll have a decline that will feel like a bear market. Perhaps it's because of the market testing new Fed chair. But keep in mind, a lot of the markets already had a drawdown in the Mag 7, crypto, and software. And then I think a rally follows because fundamentals are strengthening, maybe one of the strongest rallies we'll see in our lifetime. So just a reminder, just don't time the market, even if you're tempted to. Now let's look at individual granny stock performance. The top 5 performers in the past week were Robinhood, MicroStrategy, Cadence, Design Systems, Tesla, and Palantir. Now, Robinhood got a catalyst. Crypto's rebounding here. And, Tesla continues to do well, but they're reporting this week. The bottom 5 performers were basically defensive stocks and Netflix on its results. On the mid-cap side, the top 5 performers are listed here. Basically, it's kind of just high beta and risk on. And there was some quantum here and some positive developments around Bloom. But look at the bottom 5 performers here. And they've been solar and energy names, which have continued to kind of weaken. There is some earnings this week from Belmont. As for themes, global labor shortage remains one of the top performing themes, followed by millennials and seasonality. That's it for now. Thank you for listening, and I'll speak to you soon.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.